Gaztransport and Technigaz SA (GTT) operates as a highly specialized technology and engineering licensing firm holding a near monopoly in the critical niche of cryogenic membrane containment systems essential for the maritime transport and storage of liquefied gases. 1. The core business model is centered on licensing fees derived from shipyards utilizing GTT's proprietary NO96 and Mark III systems, which are dominant in large-scale liquefied natural gas (LNG) carrier containment. 3. The current investment thesis is characterized by a strong cyclical upturn driven by robust secular demand, which positions GTT favorably for exceptional short-term performance. However, this immediate strength is shadowed by significant existential long-term risks related to technological substitution and severe geopolitical concentration. IA. Overview of GTT and core moat. GTT was formed in 1994, merging two technologies, NO82 and Mark I, into the currently dominant NO96 and Mark III systems. 3. GTT systems are integrated across the entire LNG value chain, including carriers, floating storage and regasification units, FSRUs, floating liquefied natural gas units, FLNGs, and the emerging LNG as fuel market, supported by specialized services and digital tools like Moon and Tommy. 1. The company's unique IP licensing model results in minimal capital expenditures necessary for revenue generation, driving exceptionally high profitability metrics. IB. Key drivers of value appreciation, upside. The primary drivers supporting GTT's current valuation include secular LNG demand. Global LNG demand is projected to increase by approximately 60% by 2040, primarily fueled by economic growth in Asia, China, Southeast Asia, and the energy transition toward cleaner fuels in heavy industry and transport. 7. Record order cycle and visibility. The company is fully capitalizing on an unprecedented global shipbuilding boom, evidenced by a record 84 million tons per annum (MTPA) of LNG projects reaching final investment decisions (FIDs) in 2025. The extensive order book of 295 units, excluding LNG as fuel, provides guaranteed revenue visibility extending robustly through 2028, valued at an estimated €1.698 billion. 10. Exceptional profitability and operating leverage. The IP licensing model delivers immense operational leverage. This is evidenced by the 65% growth in EBITDA in 2024, far outpacing the 50% revenue growth. The EBITDA margin reached 68.0% in H1 2025. 14. IC. Primary investment concerns, downside risks. The primary risks threatening GTT's long-term terminal value are concentrated and severe. Technological substitution threat, KC2C. The successful maiden commercial voyage of a small LNG carrier equipped with South Korea's localized KC2C containment system represents a direct, strategically motivated threat to GTT's core revenue. South Korean shipyards, major customers of GTT, seek to eliminate high royalty payments, estimated at $7.2 million to $14.4 million per ship. 5. Geopolitical concentration. GTT's revenue is almost entirely concentrated within Asian shipbuilding hubs. China holds 61% of the current global order backlog, and South Korea is the world's leading LNG carrier builder. 5. This reliance exposes GTT to significant risks stemming from U.S.-China trade tensions, export controls, and strategic governmental efforts to localize technology or redirect supply chains. 17. Diversification failures. GTT's attempts to diversify revenue streams into adjacent markets, notably the LNG as fuel and hydrogen segments, have resulted in significant revenue contraction in 2025 and are currently acting as a drag on non-core profitability. 9. 2. Business overview and technological moat analysis. 2A. Core business model, the IP licensing engine. GTT's business foundation rests upon a patented intellectual property licensing model. The company generates revenue by charging fees to shipyards and engineering, procurement, and construction firms such as Samsung Heavy Industries and Hedong Zonghua for the right to use its proprietary cryogenic containment designs when constructing vessels or terminals. 2. This IP-centric structure ensures that GTT maintains minimal manufacturing risk and fixed costs relative to its revenue base, which is the root cause of its superior operating leverage. GTT is strategically involved across the LNG value chain, including supporting ship owners and terminal operators with services and innovative tools. 6. For instance, GTT offers solutions for floating storage and regasification units, FSRUs, floating LNG solutions, FLNGs, and consultancy services, which include engineering studies and operational support for GTT membrane systems. 1. The company also provides decision-making tools for optimization, such as its proprietary monitoring software. 6. 2B. Deep dive into proprietary cryogenic containment systems. GTT maintains its near monopoly through continuous technological innovation in its two dominant membrane systems, NO96 and Mark III. These technologies are critical for maintaining LNG at -162 degrees Celsius with minimal loss. 2. Membrane systems currently dominate the global LNG carrier market, commanding a far greater market share than the older, less space-efficient Moss-type spherical tanks. 21. GTT's designs were adopted in over 75% of LNG tankers delivered between 2022 and 2024, demonstrating established market leadership. 4. 2BI1 NO9 System Technical Specifications. The NO9 system is a non-self-supported liquid cargo tank system. 22. A defining characteristic is the use of Invar alloy, a specialized metal containing 36% nickel for both the primary and secondary membranes. 22. Invar alloy possesses an extremely low thermal expansion coefficient, which is crucial for preventing structural fatigue and failure under the extreme cryogenic temperatures required for LNG. 22. The system relies on various insulation materials, including perlite or glass wool and foam housed in plywood boxes with bulkheads to optimize thermal performance. 23. 2BI2 Mark III System Technical Specifications and Performance. The Mark III system is structurally supported by the ship's hull and uses a corrugated stainless steel primary membrane combined with a secondary composite membrane. 24. GTT continually refines this technology to improve thermal and structural efficiency, primarily measured by the boil-off rate, the daily volumetric loss of cargo due to heat ingress. 24. GTT's most advanced iteration, the Mark III Flex Plus, guarantees a BOR of only 0.07% V per day for a 170,000 meter cubed vessel, achieved through increased insulation thickness 480 millimeters. 24. This figure compares favorably to the 0.10% to 0.085% BOR guaranteed by the Mark III Flex system. 24. The continuous technological refinement of these systems is necessary to maintain the competitive advantage. For instance, the newly introduced ballast split design aims to partition ballast tanks to reduce liquid motion, sloshing loads, and optimize BOR, particularly in challenging partial cargo loading scenarios common for LNG feeders and bunker vessels. 26. The proven technical superiority of GTT's designs serves as the primary justification for its pricing power. High-performance containment technology such as the Mark III Flex Plus and its 0.07% BOR, 25, directly reduces operational costs for the vessel owner by minimizing cargo loss and lowering the required energy for boil-off gas, BOG management. This superior thermal performance leads to significant lifetime fuel savings and cargo preservation, thereby justifying the substantial licensing fee paid to GTT, reported to be in the range of $7.2 million to $14.4 million per ship. 5. This deep economic benefit confirms that GTT's dominant market position is founded on the demonstrable economic value delivered by its intellectual property. A consequence of GTT's highly specialized business model is the necessity to transfer its sensitive intellectual property, including proprietary welding protocols for cryogenic materials and complex engineering specifications, to international shipyards for manufacturing. 18. While this approach facilitates rapid market penetration across major shipbuilding centers, South Korea, China, it concurrently escalates the inherent risk of technological replication and IP appropriation. This systemic risk is already materialized in the concerted efforts by the South Korean shipbuilding industry to achieve technological self-reliance, with the KC-2C system being the latest outcome. 5. The reliance on geopolitical rivals for manufacturing the core product creates a feedback loop of potential competition, where commercial success directly fuels the capabilities of potential disruptors. 3. Global market dynamics and growth vectors. 3a. Macro LNG market tailwinds. The long-term outlook for the LNG sector remains exceptionally strong. Global demand for LNG is projected to increase by approximately 60% by 2040. 7. This growth is fueled by fundamental shifts, including robust economic expansion in Asia and the increasing adoption of LNG as a 3b. Drivers of fleet renewal and expansion. Beyond macro demand, regulatory pressure is accelerating the replacement cycle for the existing global fleet. New regulations imposed by the International Maritime Organization, IMO, are tightening emissions and efficiency standards. It is estimated that over 350 older LNG carriers may be impacted by rising compliance costs as early as 2028, creating a significant incentive for ship owners to accelerate fleet renewal. The industry is also completing a technological shift in propulsion, moving away from older, less efficient steam turbine vessels toward modern dual-fuel diesel-electric DFDE/TFDE and XDF two-stroke propulsion systems. 21. The majority of vessels currently in the global order book are highly efficient two-stroke vessels, typically in the 174,000 meters cubed capacity range, which represents GTT's core market segment. 20. The record level of FIDs sanctioned in 2025 represents the foundational input for GTT's sustained revenue growth over the subsequent 5 years. Because GTT recognizes its licensing revenue based on construction milestones achieved by shipyards, the confirmed order backlog, 295 units, is an extremely reliable leading indicator of the company's sustained financial performance. 10. This guarantees that the significant revenue surge experienced in 2024 and 2025 will be sustained and likely accelerate as these record orders progress through the construction pipeline, providing high visibility through 2028-2030. 3C. Floating Solutions Market, FSRU/FLNG. The Floating Storage and Regasification Unit (FSRU) market offers a flexible, fast-to-deploy alternative to traditional onshore import terminals, driving persistent demand for these units in regions with developing gas infrastructure. GTT technology has become the established standard for new-build FSRUs. 30. However, GTT has revised its expectations for new FSRU orders downward to 10 to 20 units over 2020-2029 from an earlier 30-40 projection. 29. This reduction is attributed to the growing economic attractiveness of converting older LNG carriers into FSRUs. 29. Older steam turbine vessels are increasingly uncompetitive in the modern spot freight market, but serve as ideal candidates for conversion due to ample availability and lower required LNG import volumes for floating power generation projects. 29. The increased industry likelihood of LNG carrier to FSRU conversions creates a defensive mechanism for GTT's revenue profile. Given that virtually all large LNG carriers utilize GTT membrane systems, Mark III or N096, 24, GTT is guaranteed to be involved in the necessary engineering services and consulting required to certify and upgrade the vessels for their new operational profile. 31. This service stream includes conducting feasibility studies, detailed engineering work, tank maintenance optimization, and addressing specialized technical issues like sloshing analysis or boil-off gas (BOG) for conversions. 31. This deep lock-in across the existing global fleet ensures GTT benefits regardless of whether an owner opts for a new build FSRU or a conversion project. 4. Financial performance, backlog, and outlook. 4A. Historical performance and operating leverage. GTT's financial performance is defined by its ability to translate market activity directly into highly profitable revenue streams. In the 2024 financial year, revenues reached $641.39 million, representing an increase of 49.96% compared to the previous year. 32. This rapid growth resulted in earnings of $347.76 million, increasing 72.70% year over year. 32. EBITDA for 2024 amounted to $380 million, marking a 65% increase. 13. The disproportionately higher growth rate of EBITDA relative to revenue confirms the significant operating leverage inherent in the IP licensing business model. 13. Performance remained exceptionally strong in 2025. Consolidated revenue reached €600 million for the first 9 months of 2025, achieving a strong growth of 29%. 9. The core new build business, comprising LNG and ethane carriers, surged 30% and accounted for 93% of total sales during this period. 9. This performance drove the EBITDA margin to a striking 68.0% in H1 2025. 14. Based on these strong results, GTT has raised its full-year 2025 guidance. Consolidated revenue is now projected between $790 million and $820 million, up from the prior $750 million to $800 million range, and EBITDA guidance was lifted to $530 million to $550 million, up from the prior $490 million to $540 million. 9. 4B, backlog and revenue visibility. The company's robust order book provides investors with exceptional confidence in near-term earnings stability. As of September 30, 2025, the order book, excluding LNG as fuel, contained 295 units. 11. This total comprises 267 LNG carriers, 22 ethane carriers, 3 FSRUs, and 3 FLNG units. 10. This backlog, valued at approximately €1.698 billion, ensures revenue streams well into 2028. 12. Order momentum remains strong, with 19 new LNG carrier contracts, 7 ethane carrier contracts, 1 FLNG unit, and 19 LNG fuel projects received in the first 9 months of 2025. 9. These orders comfortably offset deliveries completed during the same period, 58 LNG carriers and 1 ethane carrier, maintaining the strength of the long-term backlog. 33. 4C, analysis of non-core segments and diversification challenges. Despite the overwhelming success of the core licensing business, attempts at market diversification have shown mixed results, and in some areas, significant deterioration. The digital segment stands as the successful counterexample, showing rapid revenue growth, plus 83.4% in 9M 2025, reaching $19.9 million. 9. This growth was substantially accelerated by the acquisition of Danelec, a provider of maritime data solutions, completed in July. 11. The goal of this expansion is to build reliable, high-margin recurring revenue streams via equipment sales and vessel subscriptions, reducing reliance on the cyclical new build market. 14. Conversely, the LNG as fuel segment, which focuses on containment systems for commercial vessels using LNG as bunker fuel, experienced a significant decline of minus 32.2% in 9M 2025. 9. This volatility is partially attributed to rising competition and a high comparison base from 2024. 9. The hydrogen electrolyzer subsidy, Elogen, represents the largest challenge in GTT's diversification strategy. Elogen revenue fell sharply by minus 44.5% in 9M 2025, 9, following a minus 59.1% contraction in H1 2025. 14. While Elogen, the French leader in PEM electrolysis, 35, continues its R&D and industrial roadmap, including preparation for a gigafactory and a 1 million project in Slovakia, 11, the segment currently acts as a significant drain on overall profitability. Specifically, the segment accounted for €48 million of non-recurring operating expenses in H1 2025, which, while segregated, masks the true operating profitability of the core LNG business. 14. This difficulty in scaling green hydrogen technology into a competitive market reinforces existing concerns regarding management's ability to allocate capital effectively outside the entrenched core licensing monopoly. 19. The exceptional quality of GTT's earnings profile warrants specific consideration in valuation. The company's 68.0% EBITDA margin is derived almost exclusively from intellectual property licensing, resulting in minimal required capital expenditure to generate incremental revenue. 14. This IP-based model facilitates superior cash conversion relative to typical industrial or engineering companies, such as Piers Wärtsilä or Chart Industries, which face high capital intensity and significant cost of goods sold. 36. This inherently high quality of earnings should justify a structural valuation premium.
Competitive Landscape and Existential Risk Assessment, VA, the Technological Substitution Threat, KC2C. The most significant long-term threat to GTT's franchise value stems from the efforts of South Korean shipbuilders to localize LNG containment technology and eliminate the hefty royalty payments, which are viewed as a constant financial drain, estimated at $7.2 million to $14.4 million per ship. 5. South Korea, which dominates global LNG carrier construction, has long attempted to create domestic alternatives. Their initial effort, the KC-1 system, proved catastrophic, leading to insulation flaws, cold spots, the removal of 2 vessels from service, and subsequent arbitration claims against Samsung Heavy Industries, SHI, for hundreds of millions of dollars. 27. This history underscores the immense technological difficulty of engineering cryogenic containment systems capable of safely operating at temperatures of -163 degrees C. 15. However, the redesigned Korean system, KC2C, recently achieved a crucial milestone, a successful maiden commercial voyage on a smaller 7,500 cbm LNG carrier. 15. SHI is now committed to commercializing the KC2C system for use in large, standard 174,000 cbm class LNG carriers through new constructions and retrofits. 39. The primary defense GTT possesses against this substitution is the inherent risk aversion of the global shipowner community. The memory of the KC-1 failure, which resulted in significant operational losses and legal disputes, 27, acts as a powerful deterrent. GTT's established reliability and technological superiority, represented by the proven performance of systems like the Mark III Flex Plus with its 0.07% BOR, 24, must be rigorously matched by the KC-2C on a large-scale vessel before shipowners risk billions of dollars in new assets. The engineering challenge of scaling a complex cryogenic system from a small 7,500 cbm vessel to a standard 174,000 cbm vessel, particularly in managing sloshing, pressure, and thermal integrity, is immense and provides GTT with a crucial time buffer of 3 to 5 years before a full-scale competitive threat can materialize. GTT's moat is built less on price and more on eliminating catastrophic operational risk. VB, Geopolitical and Supply Chain Concentration Risk. GTT's revenues are highly concentrated within the Asia-Pacific shipbuilding ecosystem. China and South Korea are the global leaders in order backlog and LNG carrier construction. 5. China currently holds 61% of the global order backlog. 16. GTT's technology is critical to Chinese-built vessels for major international carriers. 18. Furthermore, the NO96 system relies on the specialized Invar alloy, 36% nickel composition, 22, exposing the company to the fragility of global supply chains for strategic inputs. 17. The increasing centrality of geopolitics in corporate innovation, 17, poses a complex dual risk to GTT. Policy directives from the United States and its allies often seek to shift strategic manufacturing, including shipbuilding, away from China and toward allied nations like South Korea and Japan. While such a shift might seem beneficial by moving GTT's manufacturing base to democratic allies, it carries an acute secondary risk. Since the royalty payments to GTT are already regarded as a strategic financial outflow by South Korea, 5, Any successful geopolitical policy that concentrates more LNG carrier production in South Korean yards will simultaneously heighten the national strategic imperative to accelerate the development, testing, and mandatory adoption of the domestically developed KC-2C system. Therefore, geopolitical pressure acts as an accelerator for the technological substitution threat, potentially shrinking GTT's window of dominance faster than if manufacturing remained dispersed. VI, Valuation and Investment Conclusion. VIA, Valuation Methodology, Absolute and Consensus. Valuation models suggest GTT's stock has intrinsic upside. A proprietary discounted cash flow model indicates the stock is 11.4% undervalued with a fair value estimate of US $220.71 compared to a market price of US $195.37. The consensus among investment bank analysts is a buy rating, supported by 6 buy recommendations versus 1 sell and 1 hold. 41. The average 12-month price target is Euro $188.37, with a high estimate of Euro 205 and a low estimate of Euro $145. 1. This average target implies a potential upside of approximately plus 5.00% to plus 6.13%. 1. VB, Relative Valuation Analysis. GTT's current valuation metrics must be assessed relative to its peers in the specialized energy infrastructure and cryogenic equipment sector, recognizing the structural differences inherent in GTT's high-margin IP licensing model. GTT trades at a TTM price-to-earnings ratio of 17.7x and an enterprise value/EBITDA multiple of 15.0x. 37. GTT's 15.0x EV/EBITDA multiple appears modest when considering its market dominance, structural 68% EBITDA margins, and confirmed long-term backlog visibility. 14. Peers operating in high-growth adjacent energy transition sectors such as Chart Industries command significantly higher multiples, EV/EBITDA above 45x. 44. The existence of this valuation disconnect, where GTT's extraordinary profitability and near-term growth trajectory are not fully reflected in its multiple, suggests the market is applying a substantial structural discount. This discount is likely a direct result of the high geopolitical and product concentration risk, combined with the long-term perceived threat of the KC-2 system. The current valuation implicitly reflects a fear of inevitable long-term erosion of the company's monopoly moat, overshadowing the celebration of current operational success. VI, Recommend detailed investment recommendations. Based on the synthesis of technical dominance, financial performance, and acute long-term risks, the current recommendation is overweight, with a view to capitalize on the sustained order book visibility provided investors actively mitigate the existential technological threat. VIA, Investment Rationale Summary. GTT represents a high-quality, high-margin, defensive growth investment backed by a record backlog and secular LNG demand. Its near-monopoly IP licensing model provides superior cash flow generation capabilities relative to its industrial peers. While the long-term risk of substitution is real, the technological scaling barrier for competitors is high, offering a sustained period of protected earnings growth for the remainder of the decade. VIB, Key Triggers for Upside Realization. Sustained KC-2 scaling delays. The most powerful catalyst for multiple expansion would be external confirmation of technical setbacks or significant delays in the scaling and commercial adoption of the KC-2 system, particularly in the core 174,000 CBM carrier market. Digital segment acceleration. Continued revenue acceleration and margin expansion in the digital segment, reinforced by the successful integration of Danelec, would demonstrate a viable path toward higher margin, predictable recurring revenue, thereby reducing the market's perception of reliance on the cyclical new build market. Capital return. Consistent adherence to the stated policy of paying out at least 80% of consolidated net income as dividends provides a strong yield-based defense for the stock and reinforces management's confidence in sustained backlog monetization. VID, Investor Risk Management Strategies. Monitoring KC-2 penetration. Institutional investors must establish specific key performance indicators, KPIs, to track the commercial viability of the KC2 system, including any large-scale orders from leading non-Korean ship owners or orders specifically for the standard 174,000 CBM vessel class. 39. Evidence of successful large-scale deployment or verified performance parity, for example matching GTT's 0.07% BOR, would necessitate a fundamental reevaluation of GTT's terminal value. Geopolitical stress testing. Portfolios should be stress tested against scenarios involving escalating trade or technology tensions between the US and Europe. Such scenarios could disrupt the highly concentrated supply chain and influence the pace or feasibility of critical shipbuilding projects. 17. Diversification cost tracking. Continuous monitoring of the financial performance of the Elogen/electrolyzer segment is crucial. Given the significant non-recurring operating expenses incurred in 2025-14, sustained high costs without clear evidence of a market-competitive product or a clear revenue runway should prompt investor engagement with management regarding the viability and necessity of continued funding for peripheral diversification efforts.